Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Thursday, October 24th, 2024. Today's episode, PMIs came out, flat today. Not really having much of an effect on markets. Volumes overall were pretty low. Nothing really happened today, generally speaking. Initial jobless claims came out a little cooler than expected, and we're going to take a look at the longer-term chart of that. From the St. Louis Fed website of initial claims, I noted 2 weeks ago how we had gotten to basically all-time highs of the past several years, and I was thinking like, oh, well, is this it? Are we going to spike higher? This was the week of October 5th, and we cooled off twice in this now, going down and down again. This can really go anywhere at any time, just something to keep a close eye on. I might believe that stocks would be more bullish, and I might even get out of my Treasury positions if we were to drop below the lowest low of initial claims. But for now, we're kind of floating to mid-high level and closer to the highs of the previous years. And so, we'll see what happens moving forward. Nothing has changed regarding daily reminders. If you'd like to hear me read through them, watch Monday's show. The crystal ball reading remains bear market very soon, and the Fed won't cut fast enough to save the economy. You've probably seen every other YouTuber. If you're watching this video, chances are you watch other financial chartists and people that talk about finance and stuff. You've probably seen this chart a million times now. Everyone's doing the same thing, and it's pretty darn clear, this little wedge pattern that we finally broke out to the downside. Some people want to see a close below. I don't know if you can see it, if it's big enough. They want to see a close below the wick of Wednesday's candle to confirm a more bearish setup. So there's still a chance that we could get back above this line. As it stands, by this little pattern here, it looks like it could continue down. I don't really know. The semiconductor industry is looking like it's about to tank here, and that could pull things down with it. And so if anything, I would expect it to be dropping now, but Mr. Market can do anything, as we continue to see over and over again. Any which way that you look at it, the S&P 500 as a market cap weighted index is currently massively overvalued. Not to say that it can continue to become more overvalued, but it would make a lot of sense and not surprise me the least if we had, at the very least, a 30% correction in the S&P 500. And typically, if you go that far, a lot of the times it goes further. And then the problems kind of roll on themselves where earnings, contract. And then, PEs follow it. And all of a sudden, you can go much lower than 30%. And that's sort of what I'm expecting, honestly, to eventually play out here. But that's just me and my crystal ball. Again, rewatch Monday's show to go through my daily reminders to see my full viewpoint on that. The VIX, otherwise known as a fear gauge, this is how much option contracts are being bought and sold for. When this is elevated, it means that the market is pricing in higher potential volatility. Although it looks like we've been going sideways for quite a while, you might say, oh, well, Robschild, this looks low, especially compared to the Japanese yen carry trade blow up. Looks like we've cooled off and we're low. This isn't low, friends. At 19 in the VIX is not low. In normal good times, we want to be, around the 15 level. And, that's nearly 25% lower than where we are right now in the VIX. So, options are still showing a lot of nervousness here. To further evidence this, we can look again at the VIX Futures term structure. We're now elevated, by the way, in the VIX past the entire curve all the way through the June contract. So, the we're pricing in more volatility right now. The market is scared here. This market is scared, and there's more smart money here than there is in the pricing of the S&P 500. Your average person probably doesn't even know what an options contract is. So at the very least, a good time to be very cautious. Another chart that caught my eye today as I scanned through all of my charts is US Treasury yieldcurve.com. Very easy website to find, and I love seeing the curve. I love seeing the graph. It gives a visualization to the situation, although it is a little bit deceptive considering the time scale, because you see 1 month, 2 month, 3 months. So these first dots are changing by 1 month each, and then 4 to 6 it looks like the same interval, but this is 2 months, and then from here to here is 6 months, and from here to here is a year, and then 2 years, and then 2 years, 3 years, and then 10 years, and then another 10 years. So it's spread out. So it doesn't give you. It's not the best visualization of this. Anyway, I digress. The reason I bring it up today is simply because, everyone's keeping their eye on the very important 3-month, 10-year spread, which is still not like super close to flat. It's been flattening, but not super close to flat yet. When this uninverts, or, reverts is the proper word for that, really, it means typically that the recession has started, because it means the Fed has lowered the Fed funds rate below the rest of the curve at that point, or is expected to do so within the next few months. And that with 100% frequency, every time it happens, we end up in at least some kind of recession. I bring the chart up because although the 10-year and 3-month are still have a spread of, let's see, it's 4.7 on the 2-year, and the 10 is 4.2, so 0.5%. Take a look at what's going on with the 20-year at 4.5% versus that, or 4.54 versus the 4.7. That is a 16 basis point spread between those two. 16 points. That's practically flat. The 10-year lately has been rising, and it looks like it is going to continue to rise here. And so this is getting notably flatter, and looks almost practically, for all practical purposes, flat between the 3-year and 20-year. And now the 10-year is sort of trying to catch up to the 20-year. Taking a look at the 10-year yield itself on a daily chart, we've been, since the first 50 basis point cut, we haven't had terrible news come out. And so, yeah, it makes sense for this to go up, simply because the market's saying, hey, Fed, why are you cutting 50 basis points instead of 25? Isn't there some bad news coming out? And then we haven't had any major catalyst. We haven't had any black swan event. You just saw the initial jobless claims for the week. That was actually lower. We're not clearly in a recession by all metrics yet. And so, the 10-year yield can rise, period. Now, although today it went down by 1%, this is very clearly a higher high, higher low situation. To me, it just looks like a dip, and that we are headed back to that very formidable and important trend line, which dates back, like I bring up in many shows, to March of 2021. Sorry, let's make it a little clearer. And then we have this head and shoulders top on the 10-year. Very clear, formidable top here, cracking through, and now it's called the retest. Now we're going to retest it. I would eat my hat if we don't get at least some kind of rejection off of this line. Everybody sees this line. There's a lot of buyers of treasuries waiting for that level, and so we'll see if we get to it or not. But for me, the pattern remains we're headed straight to it. Last chart of the day, I am holding SOXS as a short a triple leverage short ETF on the SMH, the semiconductor industry. Again, we had the white whale double engulfing candle at the top here. We have a very clear, extremely clear head and shoulders looking top at the very top of the market of all history. This is just looking like it's about to play out like clockwork. We're just kind of waiting for this to break to the downside. We had this formidable red candle engulfing all these days, and then we're just kind of in it, making a flag. Pretty darn clear this is going to crack to the downside. One other pattern, by the way, that I haven't brought up that is important is the fact that this is a rising wedge. Let's see if I can get this here. So pretty darn clear rising wedge. And when you have rising wedge, typically we expect it to break to the downside. So we break out of this to the downside, and say we get to the neckline, we break the neckline. Considering the fact that this is valued as if trees can grow forever, trees can grow big, but they don't grow forever. And I think this might be a top for a good little while. But that's just me and my crystal ball, and that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.